Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Vistra Corp, ticker VST, a major player in competitive power markets.
A very, very interesting one right now, given everything happening with energy demand.
Absolutely. So Vistra is leveraging its integrated model, which is, this combination of generation and retail, to effectively hedge wholesale power volatility. And in doing that, it's positioning itself as really the infrastructure engine of the AI era by securing these premium nuclear power purchase agreements and projecting a massive, a 50% plus increase in free cash flow per share by 2026.
That's the number that's catching everyone's eye. It's an enormous projection.
It really is. So our mission for this deep dive is to analyze Vistra's recent performance. We're looking at the Q3 2025 results and their strategic moves to figure out if this aggressively forecast growth trajectory is truly grounded in sustainable operations, or if it remains vulnerable to some hitting risks.
And there are definitely risks, particularly those that come from the operational complexity of managing such a device and, sometimes aging national fleet of power plants.
That aggressive growth forecast is the headline, certainly, and it really defines the bull case for the stock.
It does, but I think, you can't really understand the confidence behind those numbers without first dissecting the fundamental structure of the business. Vistra isn't just a power producer.
Right.
It's an integrated power manager, and that structure, that's what provides its strategic moat, especially given the increasingly volatile environment we're seeing in competitive wholesale power markets.
Okay, so let's unpack that. The integrated model. It really is the foundational concept here. We hear that term thrown around a lot, but what does it actually mean for Vistra in practice? And I guess more importantly, how does it translate into tangible financial stability for you, the listener?
Well, essentially, Vistra is built on two massive complementary business pillars. And they're designed to actively counteract market forces against each other. On one side, you have the competitive power generation segment. This thing is enormous. Vistra operates the nation's largest competitive power generation fleet. We're talking roughly 44,000 megawatts of capacity spread across multiple regions. The scale alone is, well, it's noteworthy.
44,000 megawatts, just to put that into perspective for our listener, that's enough to power several major metro areas simultaneously.
Easily. Then on the other side of the business, they operate a substantial retail electricity business. This is the part that purchases and then sells power directly to consumers, and it's serving approximately 5 million customers.
So that's the key pairing, production with the retail service. But why is that the critical differentiator? Doesn't the retail side just introduce a lot more logistical complexity?
It does introduce complexity, yes, but it dramatically stabilizes the revenue. This pairing is the mechanism for what we call the natural hedge.
The natural hedge,
Yeah.
Okay.
Think of it this way. In a standard competitive market, you have a pure play generator, someone who only produces and sells power onto the wholesale market. They absolutely love it when wholesale prices spike, right? Because their revenue just soars.
Of course.
But conversely, when those prices collapse, their margins can be completely wiped out.
Right. They are entirely exposed to the volatility of that spot market.
Exactly. But Vistra is shielded.
Yeah.
So when wholesale power prices soar, let's say during a sudden heat wave in Texas, the generation segment benefits immensely. They're selling power at incredibly high prices. But the retail segment, which is committed to selling power to its 5 million customers at largely fixed rates, it actually takes a margin hit. It has to go out and buy that now expensive power on the wholesale market to fulfill its contracts. So its costs go up.
So one side's win is the other side's pain, but it's all inside the same company.
Precisely. And when the market turns, the dynamic just reverses.
So if there's an oversupply of power and prices crash?
Now the generation side takes a revenue hit, no question. But the retail side suddenly benefits because they can buy extremely cheap power to supply their fixed-rate customers. Their margins expand dramatically.
I see.
And because Vistra operates both of these segments within the same geographical markets, like ERCOT and Texas is the prime example, those price risks largely cancel each other out internally. It just dampens the extreme swings that pure play generators face, and it turns what could be chaos into, pretty predictable, stable cash flow. This structural engineering. That's the true strategic moat.
That structural hedge makes the base operations sound incredibly robust. So now let's drill down into the generation fleet itself. 44,000 megawatts is huge, but it's the composition that really matters. What assets form the backbone here, and I guess which are the strategic assets Vistra is leaning on for its future growth?
It's a diverse fleet for sure. It uses multiple fuel sources, but the operational backbone is overwhelmingly natural gas. Natural gas accounts for about 62% of their total generation capacity.
62%.
Yeah. And this dominance is strategic because gas provides what we call flexible dispatchability, the ability to ramp up or down really quickly. That's essential in modern grids that are, increasingly reliant on intermittent sources like wind and solar.
Gas is flexible, but it's also subject to its own price volatility, right?
It is, which is exactly why the other component, the non-dispatchable baseload power, is really the strategic prize here. Vistra owns and operates the second largest competitive nuclear fleet in the entire United
The
States.
second largest. That's huge.
It is. And nuclear power is so crucial because it provides high capacity factor, 247 baseload power. It runs regardless of the weather, regardless of the time of day. As grids lean more and more into renewables, the value of that reliable, always-on baseload capacity it's absolutely skyrocketed. It's turned those nuclear assets into the crown jewels of the portfolio.
So we have the natural hedge from the retail segment providing stability, and we have the fleet composition, that gas plus nuclear mix, providing flexibility and reliability. But they don't stop there, do they? They layer on active financial hedging, too. So how much visibility do they actually give investors on their revenue streams?
It's remarkably high visibility in the near term. I mean, it's something that's often unheard of in the merchant power space. Their comprehensive financial hedging strategy, using forwards and futures contracts, it lays another level of certainty right on top of that integrated model.
And do we have numbers on that?
We do. When we look at the specific data from their filings, their generation output is hedged at approximately 98% for the full year 2025
The 98%.
and 96% for the full year 2026.
Wow, that's phenomenal certainty. It essentially means their revenue streams for the next 2 years they're nearly fully locked in and protected from any adverse price movements in the short term. It provides a rock-solid runway for all their growth initiatives.
Precisely. It completely de-risks the short-term execution. But you raise a critical point there. How far out does that certainty extend? Because if we look beyond that immediate horizon, the hedging percentage drops off pretty significantly for 2027. It lands at around 70%.
Okay, let's talk about that drop-off for a minute. 70% is still stable, for sure, but it signals significantly higher market exposure compared to the next 2 years. What's the strategic implication of allowing that hedge percentage to slide? Is that a sign of risk, or is it maybe management signaling confidence in forward pricing?
I think it's likely a calculated risk, and it probably signals confidence. When management chooses to keep a higher percentage of future output unhedged, or open, as they say, it generally means they're anticipating, or at least strategically accepting, greater exposure to a market they expect will appreciate significantly.
So they think prices are going up.
I think so. Given the structural changes in electricity demand we're seeing, that 70% hedge suggests Vistra believes wholesale power prices in 2027 will be significantly higher than where they could lock them in today. If they're right, that 30% unhedged output is going to drive explosive upside.
But if they're wrong?
If they're wrong, however, that's where the market volatility risk really reemerges.
And this is where it gets really interesting, because that solid de-risked runway is pointed directly at these massive growth drivers that everyone is calling the AI energy supercycle.
Yeah.
The market has structurally shifted, and Vistra seems perfectly positioned to capitalize on this new era of scarcity.
Oh, we are definitely seeing structural tailwinds that have moved us beyond just, incremental standard economic growth. Demand is soaring due to what Vistra themselves call emerging load drivers. This isn't just about people buying a new microwave anymore. This is about fundamentally reshaping the grid's requirements.
Okay, let's break down those main sources of new demand that are driving this scarcity factor, especially in Vistra's core markets. First, the most visible one, the explosion of large-scale AI data centers.
Absolutely. AI data centers require just immense, uninterrupted power. And their load requirements are not just large. They're what we call high-capacity factor loads. That means they need power 24/7. This plays directly into Vistra's strength, specifically its reliable gas and, more importantly, its nuclear baseload assets, not just its intermittent renewables.
But it's not just tech giants building data centers. We also have the electrification of oil field operations, particularly in the Permian Basin, which, Vistra is heavily exposed to.
It's a huge and often overlooked component. Modern oil and gas extraction, especially deep drilling and fracturing, it's becoming increasingly electrified. They're moving away from running individual diesel generators on site and just hooking directly into the grid.
And that creates a ton of demand.
A ton. It creates localized, massive, industrial-grade power demand in the Permian Basin, demanding quick, reliable sources, which, as we'll see, Vistra is directly addressing through new builds.
And then finally, you have the ongoing long-term buildup of electric vehicle load. It's slowly but surely adding pressure to the system, primarily during those peak charging hours.
Right, so you take these three drivers, AI, oil-field electrification, and EVs, and they translate directly into accelerated, sustained, high-margin electricity demand growth.
And this scarcity, it just changes the entire financial value proposition of Vistra's existing fixed assets.
It does. They know they have the infrastructure that the new economy needs, and they are proactively positioning those fixed assets to meet this specific premium demand. They're engaged in continuous strategic discussions about potential long-term power sales directly with these large-scale consumers, the data centers, the oil field operations, to lock in high-margin contracts that further lengthen their revenue visibility.
And nothing is more suitable for securing those long-term, high-margin contracts than their nuclear fleet, which brings us directly to their nuclear monetization strategy. This really seems to anchor their long-term value proposition.
It's a brilliant strategy. It's all about removing those nuclear assets from the short-term volatility of the merchant market and converting them into, well, utility-like guaranteed long-term contracted cash generators. It's how they harvest the premium value of 247 carbon-free power.
And the centerpiece of this whole strategy is the definitive agreement at Comanche Peak.
That's the flagship deal. And the terms are just remarkable. We're talking about a definitive 20-year power purchase agreement, a PPA, 20 years of guaranteed revenue.
20 years of guaranteed cash flow, largely immune to commodity price swings. That is a huge shift in risk profile for that asset.
It is, and it monetizes 1,200 megawatts of output from their Comanche Peak nuclear facility, locking up 1,200 megawatts of high-capacity factor output for 2 decades under a premium price contract. It de-risks a gigantic portion of that asset base.
It seems like it stabilizes the highest quality portion of their generation fleet and validates the entire monetization strategy. It proves the market is willing to pay a substantial premium for reliable, baseload, carbon-free energy.
Exactly.
But this can't be a one-time win, right? I mean, if Vistra's thesis is correct, they need to show a pipeline of future monetization opportunities. What are they signaling beyond Comanche Peak?
Well, the Comanche Peak deal sets a very clear and a very strong precedent. Vistra is actively pursuing future long-term PPAs, not just at their other nuclear sites, but also at strategically important gas sites to capture similar high-load, dedicated industrial demand.
And what about growing the assets themselves?
They're investing capital there, too, to assess physical growth opportunities. They are currently running feasibility studies on potential nuclear uprates, with the results expected by year-end.
An uprate, for the listener, that's crucial because it's a capital-efficient way to grow capacity, isn't it?
Exactly. An uprate means you're increasing the capacity, the power output of the existing nuclear plants, often through things like turbine or heat exchanger replacements, with minimal physical footprint changes. It allows them to generate significantly more power from the same site without the years of regulatory and construction delays that come with building a brand new facility.
So if those studies are positive,
If those feasibility studies come back positive, it opens up a multi-year avenue for high-return organic growth from their already de-risked asset base.
Okay, so we have organic growth through nuclear monetization and potential uprates. They're also aggressively deploying inorganic growth capital. Let's pivot to the major acquisition that closed recently, Lotus Infrastructure Partners.
This was a pivotal move for them. It was about diversification and expansion outside of their core Texas markets. The transaction officially closed in Q4 of 2025, specifically on October 22nd, and it added a substantial 2,600 megawatts of gas capacity by acquiring 7 natural gas generation facilities.
2,600 megawatts is significant on its own, but the real value here, like you said, is the geographical expansion. Where exactly did Lotus take Vistra?
The diversification is key. It's about reducing their concentration risk in Texas and accessing premium pricing in other constrained markets. These acquired assets are spread across key competitive electricity markets. PJM, which is the Mid-Atlantic,
Right.
ISINI in New England, and ISO in New York, and CAISO in California. These are highly valuable markets because they often experience supply constraints and therefore have higher localized power prices. It offers Vistra a whole new revenue dimension outside of the typical volatility of ERCOT.
And the valuation of this deal, it suggests it was accretive right out of the gate, which has to bolster that forward guidance.
Absolutely. The $1.9 billion purchase price implied a pretty attractive multiple of approximately 7 times 2026 Adjusted EBITDA. And that's before even accounting for expected synergies.
So talking about good assets at a good price.
They bought reliable, geographically diverse assets at a reasonable price, which immediately supports the massive forward financial guidance we're about to discuss. This acquisition, it really solidifies the stability and the reach of their overall gas fleet, which, you have to remember, is the 62% operational backbone of their entire capacity.
And in addition to that strategic M&A, they are ignoring organic growth in their core high-demand territories. The focus on new gas builds in the Permian Basin, that speaks directly to capitalizing on that oil field electrification trend we identified earlier.
That's the third leg of the growth stool, and it's targeting a very specific, high-return niche. Vistra is committed to building 860 megawatts of new gas peaker plants, specifically located in the Permian Basin. This isn't just about general capacity, it's about dispatchable reliability.
Why peaker plants specifically, and why the Permian?
Well, peaker plants are designed to fire up quickly and efficiently, often within minutes when demand spikes. That's precisely the operational flexibility that high-load industrial customers need when they ramp up their operations.
So it's custom built for that oil field demand.
Exactly. Given the high load requirements of electrified oil fields, having dedicated quick response generation nearby reduces transmission risks and ensures reliability. These new plants are targeting an online date of 2028, and critically, Vistra is projecting mid-teens or even higher levered returns on these specific investments.
Mid-teens or higher returns, that signals really high-quality capital allocation. They aren't just building for the sake of it. They're identifying areas of acute scarcity and locking in highly profitable contracts.
That's right.
So if we synthesize all this, we have a stable foundation, that's the integrated model, a massive policy safety net with the nuclear PTC, and then these three high-quality growth vectors: premium PPAs, strategic M&A, and high-return organic builds. This combination, it leads to a projected financial step change that genuinely warrants the term transformative.
It does. I mean, the numbers Vistra has presented for the coming years are the definitive basis for the entire bull thesis. The market is rarely given such clear and ambitious guidance, especially in the competitive power space. Just look at the Adjusted EBITDA projection. Their 2026 Adjusted EBITDA is projected to soar into the unprecedented range of $6.8 billion to $7.6 billion.
That is a fundamental, nonlinear leap in profitability compared to their historical results.
A huge leap.
That EBITDA jump is impressive, but for the shareholder, the true metric of success is always free cash flow per share, or FCF per share. That's what drives valuation multiples and shareholder returns. How explosive is the growth on that front?
This is the metric Vistra is really using to define its own success, and the target is extremely aggressive. They are aiming to grow adjusted free cash flow before growth, which we can abbreviate as FCFBG per share, by over 50%.
Over 50%.
Yes. The resulting projected target is $12.60 per share by 2026.
Okay, let's pause and unpack FCFBG for a second. Why before growth? What's the significance of that?
That distinction is really important for investors. FCFBG excludes discretionary capital expenditures that are related to new growth projects, like those 860 megawatt Permian peaker plants we just talked about.
It's the cash the core business is throwing off.
Exactly. By presenting FCF before those outlays, Vistra is demonstrating the immense cash generation potential of their existing and newly acquired fleet. It highlights the money available for debt reduction and, crucially, for shareholder returns before they even decide on new builds. It gives you a clear picture of their operational machine's efficiency.
That's a great way to put it.
And on top of that, they're targeting to consistently convert 60% or more of that massive Adjusted EBITDA into adjusted FCFBG over the medium term. 60% conversion efficiency is excellent, and it signals that this surge in profit isn't just getting tied up in working capital or massive unexpected maintenance costs, though they will definitely address that maintenance risk shortly.
That kind of financial performance requires a pristine balance sheet strategy and a clear commitment to capital allocation. So what steps have they taken to de-risk the balance sheet beyond just paying down debt?
I think the biggest achievement from a de-risking standpoint has been the acquisition of investment-grade status. S&P upgraded them to BBB, and that signifies a major inflection point for the company.
And why is that so crucial beyond just lower interest rates?
Well, it drastically reduces their counterparty collateral requirements for their substantial hedging activities. I mean, this frees up billions in liquidity that can now be deployed toward growth or returns instead of just sitting on the balance sheet as collateral.
Achieving IG status right before taking on $1.9 billion in new debt for the Lotus acquisition. That seems a little risky. Doesn't that immediately stress the BBB rating? Or is the guidance truly so compelling that the rating agencies aren't worried?
That's a sharp point, and it's a tension point for sure. However, the rating agencies are likely focused on the forward-looking leverage metrics, specifically that projected EBITDA growth. Management is disciplined here. They're targeting a net debt to adjusted EBITDA ratio of approximately 2.3 times by the end of 2027.
So they can grow into the debt load.
That's the idea. Considering the massive scale-up in projected EBITDA to nearly $7 billion, they are demonstrating that the new debt taken on for acquisitions and bills will be quickly supported and deleveraged by these surging contracted cash flows. The IG rating is safe, provided they hit that guidance.
And what are they doing with all that projected FCF? They certainly aren't shy about rewarding investors. They seem to have one of the most aggressive shareholder return programs in the entire sector.
They absolutely prioritize shareholder returns, and they do it via share repurchases. Since the program started back in Q4 of 2021, Vistra has repurchased a total of approximately $6.7 billion in shares.
$6.7 billion. That figure is just staggering. It reflects a deep belief from management that the stock's valuation does not currently reflect the underlying intrinsic value.
It does. And why the focus on repurchases over, say, dramatically increasing the dividend? What does that communicate to the market?
I think it signals flexibility and management confidence. By executing buybacks, they're essentially taking the view that buying their own stock is the best return on capital available. It's also more tax efficient for many investors.
And that commitment remains central. Just in October of 2025, the board authorized an incremental $1.0 billion specifically for repurchases. They're basically telling the market, our stock is cheap, and we're going to keep buying it back until the market recognizes our growth.
And they're also actively managing their debt maturity profile.
They are. They issued $2.0 billion in new senior secured notes in October 2025 to refinance $1.0 billion of older, higher-interest, 5.500% senior unsecured notes that were due in 2026. This just strengthens the maturity profile and locks in lower funding costs for the long haul.
The financial picture is undeniably strong. It's transforming rapidly. But now we have to introduce the necessary friction. And that comes from the operational realities of running physical infrastructure, the sheer scale, the diversity, the age of Vistra's fleet. It all introduces massive operational and regulatory risks.
It does. Let's start with the policy safety net, though, which hedges some of that regulatory risk, the Inflation Reduction Act.
The IRA.
Policy support is a huge, stable tailwind, specifically for the nuclear assets.
Yeah.
The IRA established the Nuclear Production Tax Credit, or PTC. For a complex asset like a nuclear power plant, which has immense operating costs, the PTC provides a mandatory revenue floor.
Let's elaborate on that revenue floor. If wholesale power prices dip dramatically, say during a mild winter when gas prices are low, how does the PTC mechanism actually protect Vistra's nuclear income?
In simple terms, the PTC guarantees that the revenue they receive from nuclear generation will not fall below a certain threshold. If the realized price of power falls, the PTC kicks in to bridge that gap up to a benchmark price. It essentially makes Vistra's nuclear assets immune to severe market dips. It removes the commodity risk associated with those high-cost baseload generators. This is non-volatile government-backed support.
And the value here isn't theoretical. We have tangible numbers on what this provided recently.
We do. This isn't just some future concept. In Q3 of 2025 alone, Vistra recognized $145 million in transferable nuclear PTC revenues.
Wow. $145 million.
It's $145 million added directly to their top line, acting as a critical, predictable financial buffer against market downturns. It is a material piece of their financial stability picture, and it quantifies the governmental support for reliable, carbon-free baseload power.
However, the flip side of owning the nation's largest competitive fleet is that operational vulnerability that comes with having so many moving parts spread across different technologies, some of which are aging or, brand new and volatile. The risks of running physical assets are absolutely real, and they come with steep, multi-million-dollar price tags.
And we've seen two major asset failures that perfectly illustrate the high cost of this operational risk. These operational incidents are, I think, the clearest counterargument to the thesis that Vistra can achieve flawless execution.
Okay, let's start with the Moss Landing fire.
Right. In January of 2025, the 300-megawatt battery storage facility there suffered a catastrophic fire.
And battery storage, it's often lauded as the future, but it has unique and pretty volatile risks compared to traditional thermal generation, doesn't it?
It absolutely does. Battery fires, particularly large-scale industrial ones, are immensely complex to manage and remediate. This incident resulted in Vistra having to absorb a staggering $400 million write-off of the net book value of that facility.
A $400 million write-off.
And importantly, they have signaled they will not be returning that specific unit to operations. That $400 million write-off is the recognition of a capital asset that is essentially rendered worthless overnight.
And the cost didn't end with the asset loss, did it? The regulatory and environmental cleanup necessitated immediate cash expenditure.
That's the second financial sting. The fire resulted in Vistra entering an administrative settlement agreement and order on consent, an ASOC, with the EPA. This mandates specific, expensive battery removal and site remediation activities. The estimated total cost for these mandatory cleanup activities is another $110 million in cash capital expenditure.
Unbelievable.
So in one single incident involving a cutting-edge technology, Vistra lost $400 million in asset value and incurred $110 million in immediate cash cleanup costs. That's over $500 million in financial impact from a single unplanned operational event.
And this wasn't limited to the new volatile battery technology. The Martin Lake incident demonstrates the exact same vulnerability, but in a completely traditional asset, coal.
Correct. In November of 2024, the 815-megawatt Martin Lake coal unit suffered a major fire. This incident requires massive long-term capital to address. The expected return to service date is projected to be late 2025 or even early 2026, meaning that capacity is offline for well over a year. That disrupts production schedules and expected revenue.
And what's the financial impact of just the repair alone?
The estimated cash capital expenditures required just for the repair are approximately $355 million.
Wow.
Now, Vistra does anticipate recovering a majority of these costs through property damage insurance, which helps mitigate the final net loss, but these incidents still tie up massive amounts of capital, demand management attention, and interrupt expected production. This single unit failure adds another $333 million to the total incident cost tally.
So if you add it up, we are looking at nearly $750 million in combined incident costs from just 2 physical asset failures in less than a year. It profoundly underscores the high volatility and expense inherent in managing this national infrastructure engine, even when it's run by an experienced operator. These costs, even if they're partially covered by insurance, represent a major drag on those surging cash flows.
And this operational vulnerability isn't just limited to physical failures. It extends into their development pipeline, demonstrating these persistent industry-wide challenges. Vistra specifically noted that ongoing supply chain issues are creating major development headwinds.
What part of the supply chain specifically is causing the bottleneck for their future projects?
They cited significant delays on critical high-voltage transformers. These are absolutely essential components for integrating new generation, especially large-scale renewables, onto the grid. If the transformers don't arrive, the project can't be interconnected, and therefore cannot generate any revenue.
So if the transformers are delayed, what does that mean for their transition and diversification efforts toward renewables?
It means timelines are being pushed far out into the future. Some of their planned renewables projects, which are crucial for their longer-term portfolio diversification and emissions reduction goals, are now seeing expected online dates pushed all the way back to late 2029.
Late 2029.
And this is critical. Their near-term explosive growth projections are almost entirely dependent on their legacy, thermal, and nuclear assets. That places all the execution pressure on those aging assets, which, as we just established, are subject to severe, high-cost operational vulnerabilities.
Which brings us to the final verdict. When we synthesize everything, the bull case that's built on the financial projections and that structural moat, it's incredibly compelling. It's really difficult to deny. We have the achievable 50% plus growth in FCF per share and the stabilizing force of the investment grade rating, which de-risks their entire financing structure.
I agree. The combination of structural market tailwinds driven by the AI sector, coupled with securing high-quality, premium, long-term nuclear PPAs like Comanche Peak, it provides a powerful and differentiated narrative of controlled, high-margin growth. They're translating grid scarcity, which is the most valuable commodity in power, into predictable, multi-decade cash flow.
So if the growth thesis is so clear, what's the tension here? Is VST currently priced for perfection, just assuming this incredible outlook plays out without a single hitch?
That is the core conflict that you, as the investor, must resolve. The aggressive guidance that projected jump to $12.60 FCF per share by 2026, it relies heavily on flawless operational execution across this vast, geographically and technologically diverse fleet.
But it's not flawless.
It's not. The concrete evidence of the past year, the $400 million write-off at Moss Landing and the $355 million repair bill at Martin Lake, provides hard, irrefutable proof that the system carries immense, non-trivial operational risk.
In short, these unexpected incidents could easily disrupt expected production. They could drain hundreds of millions in capital for maintenance and disaster response, and thus threaten the financial stability and the investment-grade status they just achieved. The growth is real, but the cost of running the infrastructure engine is terrifyingly high.
The final assessment really has to balance the explosive potential of contracted AI power demand against the high cost and volatility of managing the physical infrastructure that delivers it. They have created a financial machine, but that machine runs on infrastructure that breaks, and it breaks expensively. The execution pressure is high, and the stock's valuation multiple reflects a strong belief that these major operational incidents are aberrations, not future norms. If they manage to execute, the rewards are immense. If the operational risks persist, that valuation is highly vulnerable.
The massive forward guidance is compelling, but the sheer scale of the maintenance and disaster response costs hundreds of millions in single incidents, raises a critical question for the investor. Is the market sufficiently discounting the risk inherent in operating the national infrastructure engine, or is future growth already fully priced in?
Risk defined, portfolio protected.